There's actually plenty of research that shows small cap managers in Australia add value, but it becomes much, much harder once you've got $1 billion to invest. I worked for 10 years at Intelligent Investor, which is our online subscription business. And for 5 of those years, I was the research director, where our model portfolios did about, I think, 5% per annum better than the index. So it was a good time to be an investor. But today, I want to talk to you about the launch of our ethical fund or ESG compliant fund. But if you're not thinking about this stuff, you're really putting your portfolio and your retirement at risk. I'm going to talk about returns very shortly because I think the first thing that people think of if they have to invest with being compliant of ESG factors or ethical factors, then they're going to suffer lower returns. And I don't believe that's the case, and I'm going to show you some numbers why. All we're doing is putting a negative screen on essentially the ASX 300 list of stocks. So we're just going through and looking at what the industry standard is of what is not non-ESG compliant stocks, and we're just taking them out and then putting a portfolio together with the remaining stocks. So standards are evolving all the time, and no doubt what's ethical today may not be ethical in the future. We'll just adapt as the industry adapts. If you look at any ESG or ethical fund in Australia, you will see this table on the website, just about guaranteed, because there hasn't been a lot of research done on ethical funds because they haven't actually been around for very long. And they say over the last 10 years, if you were in the average ethical fund, you would have earned 5.4%. And if you're wondering why that's quite low, it's basically because the 10 years, it's almost 10 years to the day. In fact, it was 7 days ago when we hit the low of the GFC. So then they compared it to the average large cap Australian shares fund, which only did 3.5%. So that's almost 2% annually per year better you would have done over a decade, according to these numbers. So imagine if you could just increase your returns by 2% a year. The problem I've got with this slide is that it only incorporates the last 10 years, which goes hand in hand with the longest bull market in US history. I'm guessing that if you had a look in these ethical funds, you would probably see a really, really big helping to companies like ResMed, CSL, Fisher & Paykel Healthcare, and these types of stocks, which are all trading on around 30 or 33 times earnings, so about double the price to earnings ratio that they've historically traded at. So I don't think this 10 years is a particularly good period to be looking at because I think the numbers are inflated. So I thought I had a bit of a genius insight, and I thought, where can I actually find some better numbers that will give me a better idea of whether we can actually make more money investing this way? And I thought, brilliant, we've got 420 recommendations at Intelligent Investor going back to 2001. Why don't I just go through the list, remembering, as Ron said, it's been audited every year. So every recommendation has been audited. Why don't I go through the list of 420 stocks and tick which ones would pass our ESG filters and which ones wouldn't, and then I'll have a look at the difference between the returns. The average return was 14.8%. And the average return for those who wouldn't have passed our filter was 10.1%. And I was sceptical as well, but when I went back and did this, I think the best thing that could give you some sort of lead of what sort of returns we can produce, it's going to be using our Intelligent Investor process that's been, as I said, going back to 2001, and it clearly shows if we'd avoided some of those non-ESG compliant stocks, we would have done much better. There are increasing risks coming from ESG concerns, and this is what I want to talk about. Even if you don't want to invest in our fund, you need to be taking this stuff seriously because this stuff is snowballing and it's becoming more important every day. We've seen the Hayne inquiry. So if you're a company or working in an industry that's not ticking off on these ESG criteria, then the government is coming for you. And it doesn't necessarily mean that your business is going out of business, but it's probably going to mean lower profit margins, lower profits and lower dividends. All right, so these things are changing. So if the government's not coming for you, then competitors with superior products that do tick off on these ESG criteria are coming to market with better products. So I've got this quote from Winston Churchill, says, to improve is to change, to be perfect is to change often. So the important point I want to make with this slide is that just because we're launching an ESG compliant fund or an ethical fund doesn't mean we're changing our investment process. Just because a company ticks the ethical boxes or the ESG boxes doesn't mean we're going to buy it. It still has to pass all our normal qualitative and valuation input that we put through the Intelligent Investor process. So this is really just another screen to reduce risks from the list of stocks that we can choose from. There's this great quote from a guy called Jesse Livermore, and he made and lost 3 fortunes. But he actually had the way we invest sorted out about 80 or 90 years ago. And he said, it was never my thinking that made the big money for me, it was always my sitting. And if you've been an investor for a long time, you know how hard it is to actually do nothing. So I just want to talk very quickly, for those of you that aren't familiar with the intelligent investor process, I've tried to just summarise it here. And we're always looking for high quality businesses. We're not, occasionally you find the cigar butt, the really hated, horrible, statistically cheap thing, but we've always generally preferred quality because, using CSL as a well-known example, you just get that compounding over time and it minimises your taxes. And again, as a fund manager, the best thing I can do is put your money in those sorts of companies and then just stay out of the way. We're looking for high insider ownership. We want long growth runways because we don't want to be in those sunset industries. And these days, the price of being on the wrong side of technological change is a rapid decline in your business. And as always, we want to buy 50-cent dollars, but in the market like we've got, we need to be very pragmatic about that and stick to quality. On the bottom there's, some of you may recognise the idea of special situations, but it's a bit of US jargon. And basically it just describes a few common instances on the stock market of where we can find value, because with something like a Woodside or a Woolworths or a Coles, the market tends to be very efficient about the valuation. And as value investors, we really only make our money when we find the market's mistakes and we invest your money in those undervalued securities. So whenever you look for a company, you may remember about 5 years ago, Steve Johnson and I did this roadshow, and Steve was talking about a company called ServiceStream, which I think is up about 12 or 13-fold since then. And at the time, the performance of the stock was terrible. A whole heap of people were very frustrated. They sold out. They didn't want to be part of the capital raising, but the company raised capital and diluted existing shareholders. They sacked the CEO and they brought in a new guy called Lee McIntyre, who was an internal appointment. Now, no one knew anything about Lee McIntyre, but if you talk to some of the people that invested in ServiceStream today, they think he's arguably the best CEO in Australia. But back then, no one cared. Everyone was just so pissed off with their returns and the loss of money. They didn't care. They didn't want to stick around. No one wanted to see who this Lee McIntyre was, and they just didn't care about the business. But that's precisely the point, at that point of maximum pessimism, where if you can do your research and you can get comfortable with the new CEO, when you're most likely to find a bargain. So I'm looking for these situations where there's a new CEO, a recapitalised business, a spin-off, which we're seeing more of in Australia. So the funds management business of the banks look like the next ones, and companies with hidden assets. So features of their business that don't screen very well on a computer system. So if you're a value investor and you're all about Warren Buffett, you're looking for high return on equity, good stable earnings growth, low volatility in the earnings, good dividends. At the moment, all that stuff is priced up here. So we need to work much, much harder to find value. These charts, you don't need to know the details here, but this is just what I want to describe to you. To me, it was important well before we started talking about ESG factors. But to me, the best corporate governance is having the founder running the business with his reputation on the line. And so on the left-hand side, this chart only goes up to 2014. Again, you don't need to worry about the details, but you can just see the two lines, and the top line looks at the S&P 500 companies, and the top blue line is the founder-led companies, and you can see the share price performance of those select group. There's this dynastical wealth in these businesses that have been owned by families for generations, and they're thinking about handing it down to 1, 2, and 3 generations ahead. They think very long term, they don't take on too much debt and put the business at risk. They're slow to make decisions, but they act decisively when a bargain comes along. So this slide is really just telling you that ESG is becoming the norm. I think when we come back in 5 years' time, we won't really be talking about ESG factors on their own. They'll just be a normal part of the investment analytical process. And ESG is really coming into its own at the moment because we've got changing societal attitudes, there's increasing pressure on governance, reducing risk is just good business, and Woolworths, for example, is looking at selling its pubs business because it's got the exposure to pokies. So what's in it for you? So the launch of the fund, it'll be easy to invest in. It'll be listed on the ASX just like a regular stock, so you can buy and sell it just like a regular stock, but it'll be a ready-made portfolio where I spend all that time doing nothing to find stocks to put in it. It's the same intelligent investor long-term approach. It's focused on high-quality businesses. The long-term holdings that we help will minimise tax. So the last thing we want to be doing is making our brokers rich. Have semi-annual distributions and the same regular reporting and candid communication that I think Intelligent Investor and InvestSMART are known for. And we've got a fixed management fee and no performance fee. So this company, the code is TGP. It's called 360 Capital. And you can see on the left-hand side, going back to the March in the GFC 2009, my mate and I thought we were pretty clever, and we bought into this stock, and we enjoyed that nice little ride over the next 18 months. We made about 70 or 80% on our stock. And the story was that you might remember back then there were all these A-REITs trading at massive discounts to the underlying property. And this guy, Tony Pitt, took control of this business, which at the time was called Trafalgar, same code though. And he said, I'm going to narrow that gap, I'm going to get the performance of the properties up by increasing the rentals, the rental prices, get the occupancy up, then I'm going to sell off the properties and reduce the gap. And he did it. He did exactly what he said he was going to do. And so I thought, great, we've made our 70 or 80%. I don't need to be hanging around this stock anymore. We'll go and find the next great idea. And so I did. And so that huge run you see in the stock from about 13 or 15 was my genius idea to stay away from. So what did I say about doing nothing? You don't need to worry too much about the details on this slide, but what it's telling you is that since the Hayne Commission in particular, the banks have been withdrawing funding from certain areas, and one of those areas is small property development. Now, this is perfect for companies like 360 Capital because they want to lend to situations like building a $13 million doctor's office in the suburbs. It's very small, very low risk, and the banks don't want anything to do with it, so normally you'd get, say, an 11% annualised return or maybe over 18 months and you get your money back. These days, when you lend money to these situations, you're earning 15%. So it's an extraordinarily high return for fairly low risk and for a short payback period. Again, don't worry about the detail on this slide, but I think you'll do just fine if you own this stock over time. And again, this is just general advice. I'm not telling you to buy it. It's a stock that I've got in all our funds, and it's certainly in our ethical fund. But at the moment, I think we'll do fine over time with Tony running this business. He'll invest. So what he's doing is, when you're at the start of a recovery cycle, so 2009, you want to be in the equity because that's where you get the maximum bang for your buck as things recover. But now we're at the absolute opposite end of that cycle. So now what he's doing is, rather than providing the equity where you've got very little protection against something going wrong, he's actually lending the money where you've got covenants to protect you. And so if anything goes wrong with the $13 million development of the property, then essentially Tony and 360 Capital have first rights, and he can go in there, put in the money that needs to, and get it done if for some reason things go wrong. And so there's some good news last week where 360 Capital is launching 3 new funds for people to invest in. And my guess is you don't go and launch funds unless you think you've got investors lined up and the projects lined up to put the money into. And at the moment in the share price, you're paying absolutely nothing for this. So this is a $200 million company that one day could potentially be, there's no reason why in 5 or 10 years it couldn't be managing over $1 billion worth of projects. Now this stock is not going to stay at $200 million if that happens. But if it doesn't happen and the funds management business is a complete failure, well, you're not paying anything for it. In the current price, you're paying absolutely zero for it. And I still think you're doing well. And to me, that's the classic value investor, intelligent investor stock. Heads, we win lots, and heads, we don't lose too much. Thanks very much for coming, and look forward to the questions.